Welcome to the Deep Dive. Today we're taking a really granular look at Zeta Global, ticker Zeta. Specifically, their 3Q 2025 earnings call that dropped after the close on November 4th.
Yeah, and our goal here is pretty straightforward for you. We want to break down the key numbers, the operational stuff, decode their, frankly, quite ambitious forward guidance, and figure out what it all means for the ad tech and martech space.
Which is, let's be honest, super competitive.
Exactly. And the market's first reaction, pretty positive. It seemed like these numbers really validated their story of, strong execution and growth picking up speed.
Okay, let's get into it then. Speed and precision, as you said. First thing that jumps out, this is the 17th straight quarter they've done a beat and raise. I mean, that's kind of remarkable in this sector, right?
It really is. Consistency like that is rare. So the core financials, let's lay them out. Revenue hit $337.2 million. That was about $9.1 million better than what analysts expected. Year-over-year growth overall was 26%, but, and this is interesting, if you strip out the political ad spend, which can be lumpy, and contributions from LiveIntent, that organic growth actually accelerated to 28%.
Right, cleaner number. And profitability, I saw as a bit of a mixed bag, depending on how you look at it.
Yeah, a little bit. The non-GAAP EPS, which is what the street usually focuses on, came in at 0.20 cents. That beat the consensus of 0.19 bunces.
Yeah.
But, full transparency, the GAAP EPS missed by about 0 to 2 cents. Minor, but worth noting. The bigger story, though, I think, is really in the margins and the cash they're generating.
Okay, tell us about that.
Adjusted EBITDA, $78.1 million. That's a 23.2% margin. And importantly, that represents 46% growth compared to the same quarter last year. Massive jump in profitability.
46% growth in EBITDA, wow.
Yeah. But here's the real headline grabber, I think. Free cash flow, FCF.
Yeah.
They generated $47.1 million. That's up 83% year over year. We're timing a 14% FCF margin now. Okay,
so hitting 14% FCF margin, that gets them to the rule of 40 on an FCF basis, right?
Mm-hmm.
Explain for our listeners why hitting it with free cash flow, not just adjusted EBITDA, is such a big deal.
Right, good question. So the rule of 40, growth rate plus profit margin equals 40% or more, it's a benchmark for healthy, sustainable software companies. Usually people look at it with EBITDA margin, but when you hit it using free cash flow margin like Zeta just did for the first time, it signals something more profound. It means the growth isn't just on paper. It's not just accounting metrics. It's translating directly into hard cash they can actually use to reinvest, pay down debt, make acquisitions. It shows the business model is really maturing and durable. It's a huge milestone.
Got it. So that cash generation power, it fuels their ability to invest in the future. Let's pivot to that. The big AI story they pushed at their Zeta live event, Athena.
Athena, yeah. This is positioned as their new conversational AI superintelligent agent. Think of it, as management described, like the intelligent operating system for their whole Zeta Marketing Platform, the ZMP.
The phrase that stuck with me was AI is the new UI, the new user interface.
Exactly. That's the core concept. They want to make using their complex platform as easy as talking to it. You basically dictate your campaign goal, like, hey, Athena, set up a campaign to win back customers who haven't bought in 6 months in the Midwest.
Okay.
And Athena is supposed to build the audience segment, draft creative ideas, launch the campaign across channels, and give you real-time feedback, all through voice or natural language commands. It basically removes a ton of friction.
Which theoretically makes it faster and easier to use, differentiating them. They seemed pretty pointed about their AI being native versus competitors.
Oh, absolutely. They made a big deal about that. They emphasized they've been building AI into the core platform since way back in 2017. It's foundational, not an add-on. And they directly contrasted this with competitors who they argue are dealing with, quote, legacy tech debt, and are now just trying to bolt AI features onto older systems.
Okay, that legacy tech debt line sounds like good marketing spin. But is there a practical difference? Can we actually see how a native AI architecture beats a well-funded competitor's bolt-on? What's the tangible benefit?
Well, the argument they make is about speed and coherence. If AI is native, it has instant access to all the platform's data, the identity graph, the intent signals, the creative assets, without needing complex, slow data transfers between systems.
Right, no plumbing required.
Exactly. A bolt-on solution often needs that extra plumbing, which can create latency or data silos. Zeta's confidence here is reflected in their timeline. Athena's already in internal beta. Client beta starts by end of Q4 this year. Full production rollout by the end of Q1 2026. So this isn't some far-off dream. They're saying it's imminent.
Okay, so big product innovation with Athena. And then there's the other major strategic piece, the Marigold acquisition. $325 million for their enterprise software business, closing by year end. This wasn't just buying revenue, was it?
No, definitely not just scale. This looks very targeted, very synergistic. Strategically, Marigold significantly beefs up their capabilities in loyalty programs and messaging, like sophisticated email. It also gives them a much bigger footprint in EMEA, Europe, Middle East, Africa. And importantly, it brings over 100 new enterprise clients, including more than 40 Fortune 500 names, big logos.
And this ties directly into their One Zeta strategy, right?
Yeah.
The cross-selling potential seems huge here.
Exactly. That's the really compelling part of this deal. Apparently, the vast majority of these incoming Marigold clients, they're only using one thing right now, maybe just email marketing, maybe just messaging.
Okay.
And Zeta's own data shows that clients using 2 or more of their platform's capabilities, let's say, combining loyalty with personalized ads, generate over 3 times the annual revenue compared to clients just using one thing.
Wow. Okay. So doing the quick math, they paid $325 million to acquire over 100 big companies that are essentially pre-qualified targets for a potential 3x revenue uplift.
That's the bet, precisely. They're buying a ready-made pool for significant cross-selling. And it's not just theory. Their existing count of customers using 2 or more use cases, that already grew over 100% year over year organically. Marigold just pours gasoline on that fire and shortens the sales process because the relationship is already there.
That momentum seems reflected in their core customer metrics too. The super scaled customer, count their term for high-spending clients, went up by 12 just in the quarter, now at 180. That's up 25% year over year.
Right. More of those big spenders means higher average revenue per customer, which is, the engine of profitable growth. And their sales pipeline sounds really robust, too.
Yeah, I saw that Zeta Live target.
Yeah, coming out of their big Zeta Live event, they're publicly targeting closing $100 million in new business just from leads generated there. Last year, that number was $57 million, so nearly doubling the ambition. It speaks volumes about market demand and their own confidence.
And it's broad-based demand, not just one hot sector. 7 of their top 10 industry verticals grew over 20% year over year. You mentioned telecom earlier, but also continued strength in consumer areas like retail, travel, auto.
And we have to connect this back to the operating leverage, how they're making money. This was, believe it or not, the 19th straight quarter they've expanded their adjusted EBITDA margins compared to the year before.
19 quarters of margin expansion. Consistent, very consistent. Yeah. And that impressive 60% FCF conversion, turning adjusted EBITDA into actual free cash flow, that figure, is even more impressive when you know it was achieved despite a significant headwind. Right, the working capital headwind. You flagged this earlier. Can you break that down simply? They mentioned an 18-point drag from things like longer agency payment cycles. What does that actually mean for their cash flow?
Okay, think of it this way. They're making sales, booking the revenue, doing the work, but they're having to wait longer to physically get the cash in the bank, especially from large advertising agencies who often have, let's say, generous payment terms.
Okay, so it's a timing issue.
Exactly. It's a temporary drag on cash collection. That 18-point headwind means their underlying ability to convert profits into cash is actually stronger than the already impressive 60% figure suggests. Once those payment cycles normalize, or as they manage it better, that conversion rate could theoretically jump even higher. Getting to 60% with that drag is pretty remarkable.
That context is really important.
Right.
Okay, let's talk forward guidance. Given the quarter, the full year 2025 raise wasn't a huge surprise, but still positive?
Definitely warranted. They bumped the midpoint of their full year revenue guidance up by $11 million. This pushes their projected organic growth, again, excluding political and LiveIntent, up to 26% for the full year. Remember, they started the year guiding to 21% organic growth, so they've added 5 full percentage points of growth expectation throughout the year. That shows real accelerating momentum.
And the really interesting part, they give an initial outlook for 2026 already. Why so early?
Yeah, that was unusual. Management said explicitly they wanted to provide a clean, organic baseline before the Marigold acquisition closes later this year and muddies the year-over-year comparisons.
Okay, setting the stage. So what did that early 2026 look like?
Pretty confident. They're projecting organic revenue reaching $1.54 billion. That's still strong growth at 21% year over year off this year's higher base. Adjusted EBITDA expected around $354 million, keeping that margin strong at 23%.
And the cash.
Crucially, FCF projected at $209 million. That implies about 59% conversion from EBITDA, so they expect to maintain that really high level of cash generation even as they grow.
And this confidence, it seems tied to what they're seeing in the market regarding legacy players.
Absolutely. Management was quite vocal. They said the replacement cycle for older marketing clouds is now at full scale. They're seeing the largest RFPs, requests for proposals, in their company's history.
And they're winning against whom?
Primarily, they say, displacing the big established incumbents. Names like Salesforce Marketing Cloud, Oracle, Adobe, the giants. And their pitch is compelling. They claim their platform delivers a 6x return on investment for clients. They even claimed this ROI is now on par with what advertisers expect from the huge walled gardens like Google and Meta.
That's a bold claim.
It is. But if true, that combination high ROI, native AI simplifying things via Athena, that's a powerful argument for CMOs looking to switch from older, potentially clunkier platforms.
So putting it all together, the results look stellar, guidance is strong, the strategic moves seem smart. Yet the stock reaction after the initial pop was a bit choppy. What's the core debate here for investors, do you think?
I think it boils down to weighing this incredible execution, the consistency, the margin expansion, the cash flow, against the lingering question of just how sustainable growth is in these ad-related markets long-term. There's always that cyclical concern. But Zeta's argument, backed by these numbers, is that they're becoming a predictable, profitable growth engine that's actively taking share because of their tech advantage. They're moving beyond just being a high-growth story to being a compounding cash generator, which might decouple them a bit from broader ad market sentiment.
Okay, that sets the stage perfectly for our next segment. And let's be absolutely crystal clear here. This is not financial advice. We are not investment advisors. Any ideas discussed are purely for informational and entertainment purposes. Always do your own research and consult a professional.
Absolutely. Clear disclaimer. But based on everything we've just unpacked, the Marigold integration, the Athena rollout, the operational leverage, you can build a pretty compelling, albeit high conviction thesis.
Okay, let's hear it. What's the outrageous but plausible trade idea?
The core idea is that the combination of Marigold and Athena accelerates things much faster than the market currently expects. Marigold brings the clients, Athena makes it super easy to turn on more features that one Zeta cross-sell.
So faster adoption of multiple products per client.
Exactly. And Athena doesn't just help revenue. That AI-driven workflow efficiency should also improve gross margins and, importantly, help them manage and potentially neutralize those working capital headwinds faster than guided, faster cash conversion.
Okay, so the thesis is underestimated acceleration on both revenue per client and cash conversion.
Precisely. So the trade idea. Go long Zeta. The bet is that this acceleration means they hit their long-term 2030 target for FCF conversion, which is 70% much earlier, maybe as soon as 2028.
Getting to 70% FCF conversion 2 years early would be huge.
It would. And to potentially amplify that bet on the market shift, you could pair the long Zeta position with a short position, not naming names, but short one of the legacy marketing cloud providers, specifically one that seems most vulnerable to this replacement cycle Zeta is driving.
So betting on Zeta winning share from the incumbents.
Exactly. You're playing the spread, Zeta's accelerated profitable growth versus the potential deceleration and margin pressure facing the older guard struggling with that legacy tech debt and AI integration. It's a pure play on the changing of the guard.
A bet that native AI infrastructure finally starts to seriously displace the complexity built up over the last couple of decades in MarTech. Interesting.
Well, that pretty much wraps our deep dive into Zeta's Q3 25 earnings. We hit the highlights. That 17th beat and raise, the Athena AI launch, the strategic rationale behind the Marigold deal.
And the final thought we want to leave you, the listener, with is this. Management talked about making AI a habit, not a headline. If they succeed with Athena, how quickly can a platform built like that truly erode the market share of giants who are, fundamentally, still playing catch-up on integrating AI seamlessly? Something to think about. Consider the power of durable, predictable, and profitable growth in a space hungry for better solutions.